morning everyone, this is Amit Pabari, founder and managing director of CR Forex. In today's presentation, we are going to discuss three things. First, we'll understand what are real yields and how it is going to impact Indian equity market. Second, outlook for dollar rupee pair, and finally, strategy for exporter and importer. Now let us first understand what is real yield. Real yield is nothing but the difference between interest rate of a country minus inflation rate in that country. When we say that any country is having a positive real yield, it means that unka interest rate is more than inflation. Now let me show you few examples. Now if you see the chart, all major economies in the world, US, UK, entire Eurozone, Japan, all are having negative real yield. इसका मतलब है वहाँ पे inflation is much higher than the interest rate in that economy. But if you see in India, interest rate is more than the inflation, which is a positive sign. When any country is witnessing a positive real yield, there is a high chances that that country may FII ka inflow can come. So we can conclude that that country will have more FII inflows. Now let us discuss outlook for dollar rupee pair. There are a lot of positive factors for the rupee, like oil prices have fallen by 20% in last 1 month. The trade deficit for the month of November has come down by close to 3 billion as compared to last month. Then dollar index has also come down from 114 to 104 kind of a level, and all Asian currencies including Chinese yuan and Japanese yen have also shown some kind of a strength against dollar, but rupee is still trading at 82.5 kind of a level. The only reason for that is that oil marketing companies are buying their imports. Now we think that in coming days, in next 8 to 10 days, their demand will slow down. Once that demand slow down, then ideally the pair should move towards 81.5 to 81 kind of a level in coming days. Now let us discuss strategy for thin margin exporters like chemical exporter or an agri exporter. As we have been discussing from last couple of weeks, that they should ideally cover on a back-to-back basis. The view remains the same. Any order they are getting, they should cover on a back-to-back basis. For covering, they can target levels between 82.30 to 82.80 kind of a level. If any exporter wants to wait, they can keep a strict stop loss of 82.10. Now let us discuss strategy for thick margin exporters like textile or engineering exporters. As the overall view of the pair is that the pair is going to move towards 81.5 to 81 kind of a level. So any uptick above 82.50 is a good level to hedge their exposure. So if anyone wants to hedge against an order, we recommend an hedging ratio of close to 75 to 80%. And if someone is hedging based on anticipation order, they can keep a hedge ratio of 50 to 55%. To hedge in this ratio, they should target level between 82.30 to 82.80 kind of a level. If they want to wait, they should keep a strict stop loss of 82.10 kind of a level. Now let us discuss strategy for importers. As the overall view is that the currency should ideally move towards 81.5 and 81 kind of a level. So for importers, we are suggesting the following ideas. For medium to long term imports, they should keep a stop loss of 83.30 and wait. For covering the near term imports, basically for next 7 to 10 days, they can target 82.10 and 81.80 kind of a level. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.